Hello, class. So I just wanted to go over the debits and credits with you and do that through the T accounts. So you'll see here we have the accounting equation. So assets equals liabilities plus equity. And then I have the different accounts that goes under those sections. And so throughout the rest of the class and whatever accounting class you take after this, you're going to have to deal with debits and credits. And I'm not sure exactly like historically how we arrived where debit increases something and then credit increases something. I'm not sure how that happens, but so I'm going to tell you how it works though, and you're just going to have to accept it for what it is. So assets are increased with debit. Okay, so over here, so we have assets are increased with debit. And then if you look at this equal sign here, on the opposite side of the equal sign, it's the reverse. So liabilities and equity are increased with credit and decreased with debit. So assets are increased with debit, decreased with credit, and liabilities and equity are increased with credit and decreased with debit. Okay, so let's just go over some examples. So let's say that there was an initial investment of $200,000 into this business. So we would increase the cash, increase the common stock. So we would debit cash, 200,000, and then we would credit our common stock 200,000. So therefore I have 200 grand over here and I have 200 grand over here. So the accounting equation balances. Now what also is going to balance is the debits and the credits. So if you have say $50,000 in debits, you're also going to have $50,000 in credits. Okay. So now let's say that I buy $5,000 worth of office supplies with cash. So I'm going to credit my cash $5,000 and debit my supplies $5,000. And then let's say I borrow $10,000 from a bank. And so I'm going to debit 10 grand to my cash. And then I will credit accounts payable bank for $10,000. So that's how that works. And then let's say I buy $6,000 worth of equipment with $2,000 cash. Okay, so $6,000 of equipment with $2,000 in cash. So I'm going to increase my equipment for $6,000. Debit my equipment for $6,000. Credit my cash for $2,000 because I bought it with $2,000 worth of cash. And then I'm going to credit my accounts payable hardware store. So let's say I bought the hardware store for the $4,000. So you see here I have $6,000 in credits and I have $6,000 in debits. Okay, so let's just keep going. Let's say that I mow somebody's yard. I charge them $500 and they pay me cash. So I'm going to credit my revenue $500 and I'm going to debit then my cash for the $500. Now let's say I mow someone's yard for $800, but they only pay me $200 in cash. Therefore, I'm going to credit my revenue $800, debit my cash $200, and then increase my receivables. I'm going to credit my receivables with $400. All right, now it's time to fill up my lawnmowers. And let's say that I'm going to fill up my lawnmowers for $80 in cash. So I'm going to credit my cash. Then what I'll do is I'm going to debit my expense. Okay, so why am I debiting the expense when under equity we increase it with a credit? Well, expenses, the more expenses you have, that takes away from the equity because the equity essentially is the net worth of the business. And so as I take away from the equity, I'm going to decrease it. So that's why we debit the expenses. So the higher the expenses go, the lower your equity or net worth goes. That's why what we call expenses, what we call them are contra equity accounts. Okay, so that's some accounting jargon for you. So commit that to memory. It's probably going to come in use later. All right, and then now let's say that the company owner wants to take $400 of cash out of the business. So we credit cash $400, and then we would debit our dividends for $400. So the dividends account is also a contra asset.